Let's start off and talk about price, kind of first of all, kind of the backdrop to all of what we're seeing at the moment. You've certainly taken advantage of a rise that we've seen in the price of crude. Is the current price of crude sustainable, do you think?
I see a lot of uncertainty in the markets, and there is a strong demand growth, and I think that will continue into this year as well. On the supply side, I think we'll see more supply from the US. There's more activity, more volumes coming in, particularly on the onshore. There's also a lot of projects that has been sanctioned prior to the downturn that will come into production on the supply side. So overall, I expect an oil price this year which probably will be lower than 70, more likely will be below 70 than above 70. But we do have a slightly stronger view in the medium term, and that is basically based on the fact that we still haven't seen the impacts of the really low investment levels that we have seen over the last couple of years.
But your sense is that you've turned a corner now. Kind of, if you read your report, if you look at your outlook, the sense seems to be certainly that the very difficult period that the sector's been through over the last 2 or 3 years, we can now call time on that.
Well, I think the sort of the deepest part of the downturn for now is over. So still facing a lot of uncertainty, and for us that is really about building resilience into our business and so that we are robust. There will be more downturn. This is a cyclical industry. There will be things coming up down the road, and for us to build resilience is important. We are now break-even positive, well below actually last year, $50 per barrel, and that's something we'll have to take very good care of and continue to improve, because when the heat starts coming back in the industry, we have seen it before, cost might come back. So for us to really continue to improve is extremely important.
You were able to keep costs, CapEx, down last year compared to expectations, at least the expectations of RBC. They came out and said cash generation was a touch weaker than they expected. What do you attribute that to? At Statoil and really industry-wide, we've seen cash generation miss the street's expectations.
So we had a very strong cash generation, more than $3 billion actually, on the year as a whole. Free cash flow after the capital expenditure, after dividend, and we forecast, that we will be cash flow neutral below $50 also for the next 3 years. So we see a strong picture on cash generation, basically based on a very high quality portfolio. So we're investing in a strong project portfolio. The projects on average has a break even now below 20 or around $20 per barrel, and that gives us a strong resilience for the volatility ahead of us.
How are as a company with shale assets, we're looking for about 1 million barrels a day for overall output growth this year. How do you see that forecast, and how are your break-evens in that area?
So we expect that the shale output, the production will increase as we have seen now. Higher oil prices, and we see rig counts increasing, and the outputs will increase. But still, we see that that is probably not enough to support on its own the growing demand. So, but we do see in some also additional volumes coming in from the conventional part of the industry, that this will keep some kind of pressure on the oil price for this year. But as I said, longer term, we expect to see the impacts more significantly from the low investment levels, and I don't expect the shale to be able to compensate for that.
Eldar, how does the cost story compare in shale right now versus the other parts of the business? You talk about kind of the heat may return at some point. Do you expect cost pressure to come from the supply chain? You're clearly trying to keep pressure down. We all remember the days when we were in the super cycle, and the cost pressure from the guys that made the shovels really was quite extraordinary. Do we ever get back to that kind of picture?
So in the unconventional part of the industry, we have seen some cost pressures. We expect that to continue. We have seen also some amazing efficiency improvements, yep. And we expect to see more, in particular on the productivity on the subsurface improvements, but some cost pressure. So we have indicated 20% increasing cost from cost of supplies and services, water, fracking, crews, and so on. So definitely yes. In the conventional part of the industry, there is still a lot of capacity in many segments of supply. So I think that we will see more balanced suppliers market in the conventional part of the industry for quite some time.
Do you expect regulations to ease in the United States further than they already have under the Trump administration?
Well, that's. I expect there will be no further, if we call it easing. I think there is room for some simplifications on the regulations, and I think that will continue. There is complexity in that doesn't necessarily serve the industry, but we still need good, high quality regulations. So I think generally there will be some meaningful regulatory adjustments, and we are really prepared to take part in discussions on how to shape that.
The smile on your face is an interesting indicator when it comes to that. The other thing I just want to ask you as well at the end was, how do you see your investor base changing going forward from here? There is a sense within the asset management community, and certainly at a sort of sovereign level, that there needs to be a downgrading of investments within the hydrocarbon space. How do you see this playing out?
I think there's a lot of work going on climate risks and how to embed that into the strategies of companies, and we are doing that extensively. So we are shaping our portfolio, focusing on carbon efficiency on oil and gas production, also introducing ambitions for our renewable business. So I think there will be more pressure on transparency. We are prepared to join those efforts, be transparent so that our shareholders and investors really can see what are the climate risks that is embedded in our portfolio and into our projects. So I think that is a development that will go on, and again, will be part of shaping that.
Eldar, you're able to make money at $50 a barrel now. You're lowering the cost of break even on new projects to like $21. You expect shale output to grow. So the production side, obviously, just continues to climb industry wide. I wonder what you think about the demand side. It also continues to rise with so much talk about electric cars and, going green. Is there any point in the near future at which you expect the demand to turn over and start to actually head down?
Yeah, I think definitely there will be. There's a lot of focus on what is the peak demand, and I think there will be peak in the balance of supply and demand. That maybe in the late 20s, that is more reasonable assumption. Still, we see a strong demand growth of 1.5, 1.6-ish million barrels a year, and I think that will that demand will continue for some time, but we will see a decline at some point, and it's really, but it's also very sticky. So this is much more than electric cars. So you're talking about the whole transportation segments, which is much more sticky than the light-duty vehicles. The industries, capturing around 50% of our outputs, even more sticky. So I think it's a really long journey to fight, the climate change in relation to oil production. So I think the peak is important, but what happens after the peak might be even more important. It's really about alternatives to oil, and that's why we also engage ourselves into alternatives and a broader energy space, and also focus on renewable energy.